Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another podcast. Today is episode number 8. We're going to talk to Russell Jacobs about life insurance and the role that it plays in the planning process. As you have probably noticed, Jacobs, Coolidge & Company is a financial planning firm first. And as a financial planner, you have to talk about insurance. But a lot of people don't look at insurance in the proper way. They get very, very fixated on a couple of aspects of it. So, Russell, why don't you begin by just telling us a little bit about life insurance, your experience with life insurance, and what the core foundation of life insurance is.
All right, Matt, I'll be happy to do that. First and foremost, life insurance is really death insurance, but no one would want to be talking about death insurance because people are already scared to talk about mortality. So creative marketing people said, let's call it life insurance because you are insuring your life. But for life insurance to pay off in a traditional sense, you have to die, and your family will receive the death benefit that you purchased. So there are a variety of types of life insurance: term insurance, universal life insurance, whole life insurance, variable life insurance, equity index, universal life insurance, and probably even other hybrids than that. But they all feature one thing in common, and it's death benefit. And under the current tax laws, that death benefit is received by the initial beneficiary income tax free because the government felt like that is going to keep a family maintaining their own economic viability, and they didn't want to tax that. So, and so far, even into the modern times, life insurance companies have been around in some form over 160 years. That's still been protected. So it has some asset protection, and it's income tax free to the initial beneficiary when things are set up properly. That's always the key, is how you set it up.
So let's talk a little bit about how you figure out how to set it up and what people need.
All right. Well, it kind of depends on where you sit in the economic spectrum, because certain products build cash value that can be used for other purposes and certain products don't. So typically, young family coming out of high school, college, first job, career, family, kids, all that, you have a lot of debt. And so term insurance is often most appropriate for that because you get inexpensive premium for a lot of death benefit because it's based purely on probability of death. So as a young person who's healthy, it's very inexpensive. In fact, even through middle age, term insurance, because of our improving and increasing longevity, has stayed pretty inexpensive. But you never end up building any residual value. So at some point in time, you cross the threshold of either where your health is not as good or a point of time in your life when you're old. Even though we don't like to think about it, we all hopefully will get the opportunity to be old. But then term insurance becomes unaffordable for the same reason it was inexpensive to start with. When it's a very low probability of you dying having the policy, it's very inexpensive. But if you're 65, 70 years old, when your probability begins to increase, so does the cost. And so it's like renting versus owning. You never build a residual value in it that can be used for any other purpose. And that's the primary difference between term insurance and any variation of the permanent insurance products that are out there. And term insurance is typically banded, meaning you can buy it where it's level for 5, 10, 15, 20, even 30 years. Whereas whole life, universal life, you have a fixed premium typically at the outset, and then that premium doesn't ever escalate at the end of some level period. And it just gives you more options in the future. But each person's situation is different, so it's really based on what is your fact pattern, what is your comfort with risk, what is your free cash flow, your ability to stick to something, because that's where a lot of people get sideways especially with permanent insurance, because they will get talked into doing it, or they'll buy it maybe with a good fundamental reason, but then they can't keep it. And then if you get out of permanent insurance, meaning whole life, universal life, any of those variations, it's a bad deal if you have to cancel out of it in the early years. It gets better the longer you have it. So early cancellation is one of the biggest issues that people have, and they shouldn't have been in it to start with if they can't maintain it.
Sure. Besides death benefit, which is the primary reason why people buy either term or permanent life insurance, what else can life insurance be used for?
Well, whole life insurance and universal life insurance, we use them for different purposes. Universal life insurance is interest rate based. And so with this low interest rate environment we've been in, the interest rates have been very low, and they will begin to trend up as rates continue to increase. But in our practice, we tend to use that, if you will, as a substitute for term life insurance, because you can determine how long do you want to pay the premium, or how long do you want the coverage to last, including into age 120, which in effect would be beyond normal lifetime, and you can guarantee it. So rather than having the issue with term insurance where at the end of the level 20 years the premium skyrockets to unaffordability, with universal life insurance you have a constant death benefit, and the premium you can select it based on how long you want to pay it and how long you want the death benefit guaranteed. And we in our practice don't really use that for cash accumulation. You know, it would be more attractive for that if interest rates were higher. But for that purpose, we tend to use whole life insurance, which is really the oldest product in the insurance universe, if you will. And people can use the cash value that develops in whole life for any number of reasons. In the 2008 downturn, we had clients whose businesses really dropped off 40-50%, so they were not profitable, and they were able to use cash value from their policies that were really in place to fund their business continuity plan to reinvest in their business. And so in that aspect, it was an emergency cash utilization. They've now, since businesses, in their case, not only returned to normal, but gotten even better, they're paying those loans back. Some people can use cash values to offset cost of college for their children because it doesn't go into financial aid formulas like the assets in 529s, mutual funds, and other assets you have do. So it can actually still be used to offset cost of college while not hurting your child's chance of getting financial aid. Another popular and effective concept is something we call a volatility buffer, where in your retirement, you've accumulated cash value in this policy, in addition to being protected by the death benefit throughout that period of time as your kids have grown up and so forth. And now it's more of a you opportunity. You protected your family with the death benefit, but you've been fortunate. You're now approaching retirement. You've retired, and then the market's down. Well, you can actually use cash value from the whole life, which is a linear asset. It doesn't go down. The dividend changes, so it may be higher or lower based on the overall investment environment, but it doesn't go down. And so you can then leave your money in the stock accounts to hopefully bounce back in some period of time while using this cash value. And it makes your portfolio much more sustainable when it has time to be left alone and recover. And really, people have used cash value for any number of things through the years. Down payment on a home, it just really can be used for a lot of good purposes if you do it in proper proportion. And to me, and we speak about this often, any product can be used effectively if done in proper proportion. Where things get out of kilter is when an overzealous salesperson or an undereducated consumer or both buy too much of something and they get out of balance. Mm-hmm. And too much of any particular asset class gives you what we call concentration risk, and you have too much exposure.
Mm-hmm. Well, let's talk about that process, making sure that things are in balance. You actually have a software that you use to make not just these sort of decisions when it comes to protection products with death benefit and some living benefit, but also just overall. Can you talk about that?
Absolutely. yes, whether, we talked about college, we talked about retirement, any of these aspects are all driven by how much you spend. We call it your personal burn rate. But how much you spend determines how much you have to have in capital to retire or pay for college or do any aspect of your life. So when we do survivor income calculations, we've determined what you spend, what your debt service is, and these type of things. And then all of the information that you've shared with us goes into this software, and we calculate if there's a capital shortfall or not. So, you always have assumptions based on inflation, assumed rates of return, age of death, which we assume age 90 in our financial planning models, even though people are living longer than that. In many cases, that's still beyond the average by a few years. And based on what you spend, that's going to determine how much insurance you need, how much investment assets you have to accumulate. And of course, we take into consideration assets that you have already developed or are developing over time, savings in your 401k plan, things like that, when your house is going to be paid off and so forth. So it's based on what you spend, and what you spend determines how much capital has to be created. And of course, the death benefit component of life insurance, when we lose a key loved one who's also a breadwinner, effectively a money machine, how much insurance do you need to insure that machine? You're already experiencing emotional devastation at the loss of your husband or wife. The only thing making it worse that we've actually witnessed is if there's not enough money, so you then have to sell your home or go back to work when you have young kids. It's just even more devastating. So, I've been doing this 32 years, and Carl's been here 22. And so we've had the misfortune of having clients, and in some cases close friends, pass away unexpectedly. And we've also had the good fortune of being able to bring money within 10 days to 2 to 3 weeks, depending on the circumstances, to help that family remain in its economic world. And, that's very rewarding, but people don't like to talk about it, and they never think it's going to happen to them. And that's one thing about life insurance is when you really decide you need it, it's often too late, because you're thinking that because something's happened in your life and you're not insurable anymore, because there's a misconception out there that you can just buy life insurance, but it's financially underwritten and it's medically underwritten. And so you have to prove worthy, in a sense, financially and physically, to be able to get coverage. And that's one of our constant challenges, is people that they think they're healthy, and then we go to get them underwritten and they're not as healthy as they thought. So They don't get preferred rates, in some cases not even standard rates. And we've had a few people even this year that got declined.
Oh,
yes, and actually found out they, had cancer. So on the one hand, the insurance exam saved their life, but on the other hand, they could no longer get insurance.
Wow.
So did that answer your question?
It did answer my question. And I think you really hit the nail on the head when it comes to, it is a difficult conversation to have, but it's a necessary conversation to have. And if your financial advisor isn't having these sorts of conversations with you, Russell, I know that you have obviously existed in the industry for a really long time, and you have been to conferences where people say, well, I don't do any life insurance. I hate life insurance. Well, it doesn't matter if your advisor likes life insurance or if they believe in it, and I'm air quoting there. Life insurance is part of a financial plan. In fact, as a CFP, aren't you ethically obliged or obligated to talk about life insurance? Isn't that part of the whole CFP certification?
Yeah, really. I mean, risk management, and for us, risk management involves talking about life insurance, disability insurance, and long-term care insurance, because these are all significant capital drains on a family if you don't have them properly. And of course, the difference between permanent life insurance and disability insurance is it can accumulate living value that you can use as a retirement supplement or some of the other things we mentioned earlier. Whereas with disability insurance, it's more like car, home insurance. If you don't use it, you've had the risk protection, but you haven't gotten any living value. people don't like that often. And then long-term care insurance. There's a lot of hybrid products now where it can be death benefit or long-term care. Or if you change your mind or something changes, you inherit money, hit the lottery, whatever, you could actually get a lot of your money back. But that's a work in progress. The insurance industry hadn't quite figured out proper pricing for traditional long-term care insurance. So most people that are looking at that are looking more at the hybrid version.
Gotcha. Any closing statements that you'd like to make for our listeners?
Well, I think the key is that permanent insurance gives you a lot of options. And whenever you decide to purchase it or add that to your protection portfolio, it always at that time is going to be more costly from an outlay standpoint than term insurance. But it's also going to pay you long-term dividends if you stick with it. So I think it's about proper suitability, really analyzing your goals and your time horizon and your risk tolerance, and making sure that you create multiple buckets of money, this being one of those buckets where it has protection capability from a death benefit standpoint, but also all these living benefits, whether it be the market volatility buffer or a supplemental retirement income in a tax-favored manner, or the college fund cost offset or assist. There's just a lot of things it does, and it's akin to building equity in your home in a sense versus renting a home your entire life. I mean, renting is great and it's suitable for a lot of people, but at some point if you want to retire and you're still renting, you're going to always have that payment. Whereas with permanent insurance, whole life in particular, you can choose a premium period of 10 years, 20 years, to age 65, to age 100, or somewhere in between. And it's a known payment period with a known amount with a guaranteed rate of return. And it's actually done better than that. It's a conservative asset that works well along with the rest of your portfolio because it protects if you don't get to finish your plan because the perils of life intervene, but it also can serve you in retirement if you do get to finish that race. So I would just say, look at the facts as they affect you, and don't get affected by all the talking heads out there and the noise, because they're talking to the masses without proper and detailed facts like you would do in a financial plan.
Yeah.
And then make a good sound decision and then stick with it and review it and update it on a regular basis, because whatever plan you do, whatever products you implement, you're going to do that, and then life's going to happen and it's going to upset your plan because that's life. And then you have to adjust it and make amends and changes for whatever did happen.
Well, Russell, thank you very much for this discussion today. I think that it sheds a light on something that has been kept in the dark. And as you just said, there's a lot of misinformation out there. So thanks, man.
Well, you're welcome. We'll look forward to chatting with you next time.
Wonderful. And if you have not subscribed to the podcast yet, make sure you click that subscribe now button below. That way, every time Russell or Carl comes out with a new idea, a new topic, or something else that they feel that you need to know, it'll show up directly on your listening device. And with that, I want to, for everybody at Jacobs, Coolidge & Company, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs, Coolidge & Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.